As we talked about in a previous lecture, the initial public offering, or IPO, takes place in the primary market and basically occurs when a company chooses to list itself on the stock market. To become a good investor, it's necessary for us to explore how and why this takes place. Any company that is created and incorporated is initially a private company, meaning that it is completely controlled by a group of owners. The reason why it is considered private and not public is that no other owner can come in and buy stake in the company unless there is a special agreement. At the same time, no shares are traded on the stock exchange. On the other hand, a public company simply means that it trades on the exchange. So let's use Twitter as an example of an IPO. Twitter was founded in 2006 by a group of computer scientists. Over time, Twitter has become one of the largest social networks, rivaling Facebook and Instagram. After growing to over 200 million active users, the owners of the company were faced with a very tough decision: to go public or remain private. They ended up opting to go public in September of 2013 in one of the biggest IPOs on the New York Stock Exchange. There are a couple of characteristics of a public company or a company that has chosen to list itself on the stock market. The first is that the company is listed on the stock exchange, whether it be the New York Stock Exchange, like Twitter chose to do, or the NASDAQ. Another vital characteristic is that a public company can be owned by thousands, if not millions of different people, all of whom become shareholders. This means that the previous owners lose some control of the company, since anyone, whether it be you or me, can buy shares in the company. So, what's the purpose of an IPO? Why would the owners of Twitter want anyone to become a part owner? Well, companies typically choose to go public for many reasons. Probably the most significant is to raise capital. Companies can raise tons of money if they choose to get listed on a stock exchange. Twitter itself planned to raise over $1 billion through its IPO. Businesses need to raise money if they want to expand their operations. In Twitter's case, they need data centers to ensure information from tweets gets stored. Those data centers can become very, very expensive and cost up to $50 or $100 million. So their two only options to fund that investment is to either raise debt or equity. Debt basically means taking a loan from a bank, and equity means issuing shares in the company and allowing other people to become shareholders. The advantage of equity over debt is that equity does not have to be paid back. When you get a loan, you are obliged to pay back the amount you borrowed with interest. With equity, however, someone can invest in your company and own shares, which hopefully will increase in value. People who bought shares in Twitter at the initial price of $26 made a 70% return if they held to the end of the day. So, how does this impact you? Well, as we just saw from Twitter, IPOs can sometimes present great buying opportunities. The biggest issue that an investor can face when trying to invest in an IPO is actually getting hold of shares to buy. Since it's become so competitive, priority is given to large institutional clients such as mutual funds or big investment firms. Nevertheless, depending on the broker you choose, which we will talk about in another lesson, IPOs may be available to you. Another important point to remember about public companies is that they are required by law to report all financial information, whether it be revenue, expenditures, or assets, to the public. So, if you're a prospective investor, it's your duty to take a look at these results to truly understand how a company operates and determine whether it would make a good investment. To sum things up, there are many reasons why a private company will choose to go public. Raising money is probably the most important one. When Twitter went public in 2013, the share price opened at $26 and ended the day at 44. Anyone who bought shares at 26 made over 70% in a single day. So, not only did it benefit the investors who became shareholders, but it also benefited the company, which eventually raised over $1 billion. That said, the IPO process is not all roses. There are a few issues a company has to deal with. A big one is that the owners lose some control of the company, and they become accountable to different shareholders. This is the reason why public companies are meant to report all financial results to the Securities and Exchange Commission, whose website anyone can access. So, if you're a shareholder or potential investor, it is in your benefit to check up on the results of a company to verify if it is a truly worthwhile investment. That's all for the initial public offering.